Okay, let's talk about analyzing and reporting variances. So any variances that we deem to be significant should be reported to management as soon as possible. And we usually do that in the form of a variance report. So the variance report looks similar to something like this. So it's similar to the income statement where we have sales and cost of goods sold, and then we get our gross profit. And then we have our variances. You can see materials, price, quantity, labor, price, quantity, and we get our total variance. And then that gives us our actual gross profit. From that, we can subtract our selling and administrative expenses and net income. Now, management will be using something called management by exception. So they're going to look at the size of the variance and look at the size of the variance relative to the amount of spending. So if we have a large variance by dollar amount or percentage, those are going to be the items that we investigate first. Now, just to recap, so the advantages of standard costs are that they are a key element of management by exception approach. So they help managers focus their attention on important issues. Standards that are viewed as reasonable by employees can serve as benchmarks that promote economy and efficiency. And standard costs can greatly simplify bookkeeping, and they also fit naturally into responsibility accounting, which we've talked about before. Now, some potential problems with standard costs. Standard cost reports are usually prepared on a monthly basis and often released days or weeks after the end of the month, so the information can be somewhat outdated. Also, if variances are misused as a club to negatively reinforce employees, morale could suffer and employees may make dysfunctional decisions. We talked before about making sure that we have standards that are high but attainable. So if we make them too high, that's going to frustrate our employees. Also, labor variances make two important assumptions. First, they assume that the production process is labor-paced, and if labor works faster, then output will go up. And second, the computations assume that labor is a variable cost, and these assumptions are often invalid in today's automated manufacturing environment where employees are essentially a fixed cost. In some cases, a favorable variance can be as bad or worse than an unfavorable variance. Too bad, if you have two extremes either way, that can be bad. It's kind of like running a cash register. Whether you're over or short, both are bad. And excessive emphasis on meeting the standards may overshadow the other important objectives, such as maintaining and improving quality, on-time delivery, customer satisfaction. And just meeting standards may not be sufficient. Continual improvement may be necessary to survive in a competitive environment.